Asia, which is half of humanity, and I want to repeat it, it's half of humanity, and it boasts some of the largest amount of young population in the world, in my 30 years has never traded such low valuations. Now you have an asset class which is not only trading at low valuations, but also trading at low profitability, which is improving, and has materially lower debt than the US. So to me, looking here for the next decade, Asia has all the ingredients to take over the leadership within the global league asset class.
Welcome to WellSaid, discussions with investors from across Wellington Management about market and geopolitical cross-currents and the long-term research required to make sense of them. I'm your host, Thomas Mucha. Well, 2023 is a fascinating time to be investing in emerging markets, given the shifting macro, geopolitical, and policy backdrops around the world. Now, are these markets poised for a rebound? To help make sense of the opportunities and risks across EMs, we have two deeply experienced portfolio managers at Wellington who both specialize in emerging markets, which have seen an increase in investor interest in recent months. I'm joined here in Boston by Hong Kong-based Meunier, who currently manages emerging markets and China-focused regional portfolios, and Niraj Bhagwat, who joins us from Singapore and is a longtime investor in emerging markets. Welcome, both of you, to WellSaid.
Thank you for having us here.
Thank you, Thomas, for having me.
Well, Niraj, let's start with you. EM equity returns have been, let's say, disappointing since the global financial crisis. 2022 was another challenging year. So what's your outlook for the asset class this year? And, thinking longer term here, how might the next decade be different for EM equities?
Thank you, Thomas. So in the last decade, the US was the clear market leader in global equities. Now, sitting here, US is sitting at peak profitability. It's accumulated a high amount of debt. Valuations, even though they are lower than last year, are still not what you would call low. And that's not what makes a recipe for great outperformance. Now, when you compare that to EM, and I'm going to talk about Asia here because remember, Asia now accounts for 80% of EM. So that's what really matters within EM. So if you look at Asia at the time of global crisis, the last big cycle, Asia profitability and ROEs were sitting at peak. Since then, they have come back to historical lows, driven by global crises as well as, of course, local crises. Also, the strong US dollar has played a key part in that. Now, as the US dollar doesn't keep strengthening, and so the headwind is gone for Asia, but also more importantly, a lot of things are changing here. So first of all, China is waking up and opening up, finally. India is off to a great new cycle. But even smaller countries like Indonesia, Malaysia are going to be helped by sustained high commodity prices. So where Asia didn't grow earnings pretty much materially at all in the last 10 years compared to, say, the US, now it's going to have sustained EPS growth in the next 10 years. And then when you take a step back, Asia, which is half of humanity, and I want to repeat it, it's half of humanity, and it boasts some of the largest amount of young population in the world, in my 30 years has never traded such low valuations. Now you have an asset class which is not only trading at low valuations, but also trading at low profitability, which is improving, and has materially lower debt than the US. So to me, looking here for the next decade, Asia has all the ingredients to take over the leadership within the global league asset class.
So the structural factors are lining up positively for EM equities. What about the risk this year? Is it the dollar? Is that the key risk that you're looking at?
So obviously this is EM, Thomas, so there are always risks, right? So a new variant which comes out, which is more toxic, which is not good for anybody, not just for China. But apart from that, I think what the Fed does, what the Japanese central bank do, all these are key variables which one must look at. And above all, one must see what happens in Russia-Ukraine war. That is obviously a key determinant what happens globally.
So, Bo, as Niraj has just stated, China's important. All eyes are on China. From your perspective, what effect will China's reopening from COVID have on other emerging markets? And then specifically with regard to Chinese equities, is there still upside potential after the rally we've seen here?
Yeah, definitely. The first answer, China's effect reopening will have meaningful impact on the emerging markets. Just before COVID happened, give people a perspective. The number of Chinese tourists leaving the country each year was equivalent to the size of Germany population. So it's a very large number of Chinese who leave the country to go out shopping and using services. Once this reopening happens, we see a number of countries benefiting from the outbound travel again, starting with Asia, where Niraj highlighted. There's a lot of travel within Asia for ease of convenience, flight, also culture, food, many reasons. So in specific countries, using Thailand as an example, they benefit tremendously from the global tourism. But Chinese tourism particularly drives a large part of that. So you can own companies like shopping malls, airports, which see increase in volume, but also more importantly in sales and profitability. So that's definitely one area. In Korea, again, people would go there for services and consumption. So just the sheer number of people going there would benefit. There's also another side of it that would be the commodities, because once China reopening, it's not just about Chinese leaving the country, but also the economic activities in China would start to resume again. We're assuming that would change now that people are out about. And anecdotally, being on the ground, my team visiting different parts of China, they are seeing resumption of those economic activities and capital expenditure. So as a result of that, I think commodity demand would increase, and that benefit a lot of emerging market countries, South Africa being one, Brazil is another one, plus Indonesia, Malaysia that Niraj highlighted. So I think emerging market benefit from all three different aspects.
So a big change across EMs. What about the Chinese equity market from here?
Yeah. So China equity market definitely was in the roller coaster mode last year. I'm happy to get into the details for reasons, but just highlighting the valuation as you touched on. So by October, it was basically looking at more than 10-year, multiple-year low. So the bounce back in fourth quarter was dramatic. But if you look at where it is now, it's many companies still below the 10-year average. So we're not definitely at the high end. It's below average, but it's not at the extreme low level. So that's starting with the multiples. Then if you look at the earnings prospect, we do expect economic activities to recover. Santiago Milan, our China economist, is expecting more than 5% GDP growth this year. With that, many companies we're talking to are expecting acceleration in earnings. Some of that is a top-line recovery. Some of that is focusing on margin improvement. And that is something I think we can talk more about. Is China had been a place where people were growing business surely from the top line. But with the slowdown economically, global and in China, we're seeing a lot more companies focusing on cost structure, focusing on efficiency. As a result of that, we are seeing improvement in margin. That can be from large companies in the internet space to smaller companies like industrial companies, logistic companies. So margin improvement is also driving some of the earnings growth. So that's why I remain constructive on China. We're starting from a below average level, but also earnings growth should accelerate.
So you remain constructive on China.
Exactly.
Niraj, what's your view on China?
You asked a question to Bo, which she answered well on the impact on emerging markets. And she mentioned about commodities, which I agree with. I think that one must also think about the impact on developed markets. So as China opens up, the sleeping giant wakes up, impact on commodities, what that means for inflation, what that means for the Fed. And I don't think many people are discussing that impact as well.
Right. It's clearly a factor that the entire world will have to grapple with. So Niraj, you mentioned India earlier. Investors struggle with the valuations of a lot of Indian equities. So how are you framing the investment opportunities there with corporate valuations in particular?
So yes, Indian valuations has always been a question. And in fact, Thomas, if you look at it, Indian valuations have always been at a premium to other emerging markets. And yet, India has delivered better performance than every emerging market. And in fact, I would say on par or sometimes bigger than the US across 10, 20, 30 years. So one must really ask, why is that? So if you take a step back, and I would say investors look at parts of EM, and especially if you look at a big country like China, people often get seduced by the size of the country, the GDP growth, the ease of doing business, the fantastic physical infrastructure, which is completely not there in India. But when I look at investing, I think when you look at China, for example, a lot of corporate profitability and drivers are because of the government. Now in India, I think everything is despite the government. So when you find companies in India which face a lot of high operational costs, and you find good quality companies which can beat those high costs, then you can have a set of companies which can deliver high returns for a sustained period of time. Now, I would say in the near term or today, there might be another reason to consider why Indian market trades at a higher valuation. And that is the TINA factor, which is there is no alternative. I can't name a single market for investors, which is a large market, great demographics, great growth potential, but also a very vibrant functioning democracy. Now, having said all that, I must admit that there are many parts of the Indian market which are expensive. And I would say the technology sector is a great example of that. But I think even today, we are finding attractive opportunities where you can find quality businesses at good valuations. And I think Indian market remains a good example of a good place for active management.
You just have to know where to look.
Exactly.
Geopolitical issues are never far from investors' minds when it comes to EM, nor are they far from my mind, of course, as the firm's geopolitical strategist. The last several years in particular have seen pretty significant national security developments in Ukraine, of course, but also across the Indo-Pacific. So which geopolitical dynamics are you most focused on right now? And this is a long list, obviously: war, deglobalization, liquidity, inflation, energy and commodities demand, as we've discussed.
Yeah. So geopolitical risk is a very important part of analysis when we look at investing in emerging markets. Definitely, my quick answer is all of the above. And actually, sitting here in Wellington, we have colleagues like you who spend a lot of time looking at this from both sides and go deeper in Washington, D.C., getting the mindset of policymakers, really help me to think about what are the risks. And I have to say, using China as an example, as an investor, we definitely have a lot of confidence from the fundamental side, but that itself is not sufficient because the geopolitical risk, if anything, is only going to intensify. It's definitely not going away. Among the factors that you talked about, I do see deglobalization is something that's structured and that's going to be ongoing. So when we think about deglobalization, there's the key part of that is the supply chain reshuffling. The globalization benefited many countries, many companies, and the reversal of that is going to start. So people should think about this not just 1 year, but much more implications from the cost, from efficiency, from inventory management. There are definitely negative implications for some of the Chinese companies that have a large share of the export, but also silver lining out of that as well. Some of the localization of supply chain may move more to Asia. So regionalization, Mexico benefit from this. Some Southeast Asian countries are seeing increasing FDI from China as the reshuffling of the supply chain. So there are definitely a lot of moving parts there. And it's not our risk. There are definitely opportunities among that. So that will probably be the first one. The second one is the global liquidity and inflation. As Niraj highlighted, when US dollar is strong, it doesn't speak well for the emerging markets in general. It just historically has never happened. So with our outlook that the U.S. inflation may be peaking, the U.S. dollar strength may be at the peak level, this is fairly positive for emerging markets in general. So I think the inflation impact will be there, but may not be as bad as the last cycle when China had such a huge property boom. We're not anticipating that type of policy or level of build-out inside China. The last part I'm thinking about is really the global energy transition. I think this is the most important topic for the next 10 years. And who are going to be the winners of this? Companies and countries with more of the leading technology on solar panel filming, on EV battery supply chains are going to be beneficial of that. And again, emerging markets, because they were suffering a lot from the commodity price, have been much more willing to develop and adopt this type of technologies. If you look at battery manufacture, Korea and China occupies a large part of the global share. So I think that's another area. It's a risk, but then opportunities also lie within some of the emerging market countries.
Yeah, I do think there's a lot of opportunity resulting from these structural changes. You mentioned supply chains, you mentioned renewable energy and the energy transition. Those are top of mind for policymakers that I speak with every day, those two issues. Niraj, same question to you. You've been doing this for a long time. How do you approach a big structural change like this in the world from an investment perspective, particularly through the geopolitical lens?
I would put that answer into two categories broadly. So in some ways, and I always tell jokingly to my clients, I'm a product of the bear markets in Asia. I started my career in 96, and Asia has not been short of wars. I think what's new is really deglobalization. That's something that we, as in current investors, haven't seen. And also one more thing which we haven't seen is climate change. And so climate change is going to exaggerate everything that we're looking at from a macro perspective. So what we do as investors is, obviously we would look at experts like yourself or other people in Wellington, but what we try to do is ask every company that we work with and try and see how the managements are thinking about it and how they can mitigate to the best of their ability. Because remember, our job is to compound client capital. We have to be invested here to compound their capital. And so the best way to, I think, mitigate all these issues is to invest in companies where managements are good custodians of the capital and where they understand these issues and can really safeguard the capital. So that's how we are approaching it.
Great. Both of you have mentioned proprietary research already as being central to your investment processes, of course. And Bo, I want to ask you about, this on-the-ground research in emerging markets in particular. So obviously that's important, but how does that play out on a day-to-day basis? What does that look like?
Emerging markets in general has a reason to be emerging and not developed. So you start with the country's political framework, with the industry dynamic, as well as the company's corporate governance. There's a lot of reason that people want to spend more time doing research. I'll start with the reason why I think we need to spend more time on the ground versus DM. I started my career in Wellington 22 years ago, covering U.S. equity. You get a lot more information, reliable information. But when I switched over to cover China equity markets, you don't have the same level of information either for company or industry or kind of where the country is heading or sometimes the policy is heading. So you need to just get more information locally to really build conviction, but also to identify risks. So how's that done? To give you an example, before COVID, when travel was easy, I would spend roughly 1 out of 3 days on the ground in China. And connection between Hong Kong and mainland China was easy. People may not realize they built high-speed train. So from downtown Hong Kong to downtown Shenzhen, you could get there in less than 30 minutes. So it was definitely an easy travel logistics, but also more importantly, the need to be there. What we do on the ground, many times we definitely meet with companies, but more importantly, you need to check around the companies, meet with suppliers, their competitors, multinationals versus locals. And again, that's where Wellington platform is helpful. We get much broader exposure to players in that industry to have a fuller sense of what is going on, where the risks are, and who is really doing well.
So China's opening is going to have an impact on your day-to-day, I assume.
Yep, definitely. We'll be back there continuously. But I do want to highlight we take our fiduciary duty very seriously. Even when China required 3 weeks quarantine just to enter the country, my team, every single one of them, went back to China to do research, to due diligence. And that 3 week is not sufficient for some companies. When you get to their city, you need to do additional quarantine of 3 to 5 days in order to visit the management. They really want to make sure you're absolutely clean of virus. And we did that in order to identify investment opportunities. So just shows you how important local research is. Despite all the hurdles, we did it.
So I'd like to move the conversation a bit to ESG issues. Niraj, from your perspective, you obviously use ESG in your process. So what are some of the most important issues, ESG issues, as seen through the EM lens here? And how much does improving performance in these areas matter to the company fundamentals?
Yeah, so I've always thought that ESG matters. And our philosophy of focusing on companies who believe in taking along all stakeholders, I think that philosophy has not changed, and who would have a problem with that? So I think when companies take along all stakeholders, first of all, that reduces the biggest risk in money management, the risk of permanent capital loss. But not only it does that, but it also improves the goodwill among its current employees, its future employees. It improves the goodwill among its dealers, its suppliers, the ecosystem, the society, and the government. And obviously, as they do that, and as investors, if we can find such like-minded companies, we can get along the journey of them getting better. That works out good results for our clients as well. So for a long period of time, issues in EM used to be the usual governance issues, which people focused, investors focused. But now more hot button issues like climate mitigation, modern slavery, women empowerment are coming to the fore. And my team, we have a belief, our process, that we try and engage with companies in almost every company interaction we do, rather than wait for just one annual interaction of ESG. And we try and ask one question at least on ESG focus. And I'll give you an example how that works. So we had a portfolio company in real estate in India. And during the COVID crisis, you know how bad situation was. And we were talking to them what they were doing about the labor. And remember, modern slavery is a real topic in real estate in India, among other places. And what we found is that this company voluntarily was not only vaccinating its employees, but the employees' families, its entire supply chain, but also contracted labor and their families. Nobody had asked them to do it. And in fact, I don't think most people know out there, so nobody has given them a high evaluation for that. But how I think that was helpful is, first of all, that created a massive goodwill among its own employees and future employees. But from me as an investor and custodian of client capital, it tells me a lot about how management thinks. And if the management can take along stakeholders, then it tells me a lot of what they think about my client's capital. I think ESG matters. And eventually, I think following and joining hands with the good quality companies with like-minded thoughts, I think results into better alpha as well.
All right, I want to pull the lens back a little bit here for both of you. And, you know, we've been discussing, and investors often discuss emerging markets collectively. But, you know, in reality, this asset class is diverse. It's a dynamic set of different countries. So I'm going to ask you both, and I'll start with you, Bo. Now, how do you approach allocating capital across this rapidly evolving universe? I mean, what's your framework here?
The emerging market research on our team has a framework we call country, sector, and company. For every single country, we run periodical reviews to look at what changed, monetary policy, fiscal policy, industry dynamic, to really identify those inflection points. We also work with our global industry analysts to, again, looking for inflection points of an industry developing on the positive or negative side. Those are framework we use regularly, whether we invest in the stock or in the country or not. And that's one starting point of the capital allocation. Then we compare them across within the EM universe using more of a conviction level, target price to identify the attractiveness. Also want to highlight the resources we have here working with the debt team. They cover even broader set of countries than we do. So working with them, seeing what they identify as a change. I think as an investor is important, but inflection points tend to be a very rewarding points to identify. So we do use a lot of resources on looking for that. That could be country, industry, or company level.
Niraj, how do you approach that daunting task?
So Thomas, when people talk about emerging markets as one asset class, I'm quite amused because if you think about the difference between South Korea and Indonesia, it's the same difference between US and China. And I'm not even talking about the cultural differences between every country. So I think that clients want their capital compounded. They don't care whether the capital is compounded in Korea, China, or Indonesia, or Egypt. And so we take a bottom-up approach. We try to understand the managements, the cultures much better. And I think the answer to that is, one is obviously try an experienced team and understand the managements better, but also, and maybe because of my past background as an auditor, I believe that to get differentiated outcomes, you need differentiated processes. So we try and be on the ground. We don't attend conferences, and we see the ecosystem, do annual road trips. That's the approach we take.
So I'm going to end here this fascinating discussion with a more personal question. You were both born and educated in probably the two most important emerging markets in China and India, respectively. So what are your favorite things to do when you return to that first place you call home? And Niraj, let's start with you.
Yeah, so I grew up in Mumbai, but I was born in a very small coastal town called Ratnagiri. And I studied in Mumbai. I used to spend a chunk of my time every year at my grandfather's farm. And so every time I go back to India, obviously on the menu is, no pun intended, is meeting friends and family. But what I really cherish is going back to my grandfather's farm and spending time on mango trees and cows.
Wow, that sounds fun. What's your favorite mango dish?
Well, do you know Alfonso mango? That's kind of a type of mango where I come from, but my favorite is mango milkshake.
All right, Bo, same question to you.
I was born and raised in northeast part of China. It's cold weather, but more importantly, the time I grew up in China, I experienced dramatic economic development, almost 30 years equivalent to 3 generations of change here in the U.S. As a result of that, I couldn't go back to my grandmother's house anymore because even the house I grew up is totally gone 10 plus years ago. But what's left is the memory and the friendship. So when I go back, definitely same thing, visiting my friends from elementary school, high school, college. The modern world is connecting people in amazing way, no matter where you are, how far apart. So when I'm back there, we definitely touch base to see the dramatic change. And the range of their life is so wide. It is very fascinating. Since I couldn't find a home, but the food is always there. And Chinese culture spend a lot of time and value on food. So dumplings is the town that I grew up in and very well known for. So if any one of you go to northeast part of China, I highly recommend dumplings. Some stores you can get 100 type of fillings, and there's nothing like that. I call that home.
You had me at dumplings. All right, Bo, Niraj, thanks again for this fascinating conversation. It's been a real joy to dig into your process and how you're thinking about this dynamic asset class. So thanks, and come back soon, please.
Thank you for having us.
Thomas, thank you very much for having me. It was a pleasure.
The WellSaid podcast is produced by Wellington Management. The executive producer is Kristen Ganong. Our senior producers are Mark Murphy, Dana Wickstead, and Colin Hopkins. Our sound engineer is Mark Murphy. This episode is mixed and edited by Mark Murphy. You can find this episode, as well as others, in Apple Podcasts, Spotify, or wherever you get your podcasts.
All investing involves risk, including the potential loss of principal. Past results are not a reliable indicator of future results. Forward-looking statements should not be considered as guarantees or prediction of future events. This material was current as of the publication date. Wellington assumes no duty to update the content in the event that the information changes. This commentary is provided for informational purposes only. It is not research that is required to be prepared in accordance with legal requirements designed to promote the independence of investment research, and it is not subject to any prohibition on dealing ahead of the dissemination of investment research. It should not be viewed as current or past recommendation and is not intended to constitute investment advice or an offer to sell or the solicitation of an offer to purchase any securities. It does not take into account the investment objectives, financial situation, or needs of any particular person. Wellington Management does not provide legal, tax, or accounting advice. The views expressed are those of the speaker and may not reflect the views of others at Wellington. This recording may not be reproduced or distributed in whole or in part for any purpose without the express written consent of Wellington Management. Please refer to the disclosure section of this podcast for complete details.